You're live.
Hello, folks. I'm David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone. We are trying again to do a little live stream of our normal market trends webinar. Let me just quickly show you some disclosures as we go. Now, there's a webinar we normally do on Thursday afternoon, but we're doing this now today to test our live streaming to Twitter and to YouTube. If you are seeing us there, thank you for joining us. And you could also reply in our comments if you see anything there, just to help us test this new way of reaching you guys. Great to be with everyone. Okay, so as usual, if you want to go to tradestation.com for more information, that would be great. Now, I want to just quickly start off by looking overall at the S&P here. Now, this sell-off we had yesterday was the biggest one-day drop since March. But in some ways, it's kind of interesting if we really look at it. We're sitting at a level here, and to me, this is very important for us to kind of just take a step back and realize this level has a lot of significance. If you look on two different respects, first, if you look at a retracement of the move that we had coming off, basically our consolidation way back here in early May, if you see here, we're essentially holding a 50% retracement of this rally from the lows of early May all the way up through the highs of July, where we peaked. So holding half of that move is something that some people will look at as a sort of trend. The other thing is we're holding above this level from last summer. And in my view, this is something that's kind of important. If we see this old resistance continuing to turn into support, it was support when we first rallied and held in June. It was support again in August. And now here it is trying to offer support once again in September. So this is a pretty important thing to be looking at. I will take a quick zoom out on the weekly chart and just say that, some people could see some potential risk here because of the fact that the market is, struggling to, if we look here, we see, oops, I'm going to go for here, our trend line, and we can see essentially that we continue to have, some higher lows here. And, this is something that this lack of follow through and breakout could make people expect some longer period of consolidation, on the weekly chart. So we have a lot of interesting things happening here. And I'll say that we're also in something of a time vacuum here in terms of events. We have nothing really huge or consequential until that non-farm payrolls report on October 6th. After that, we're going to get minutes from the last Fed meeting on October 11th. And then we're going to get the beginning of earnings season on Friday, October 13th. So Friday 13th, beginning of earnings season. But those are, 2-3 weeks away when you look out on the calendar. So that we do have a kind of space of time here where there's not a lot of things happening. Nonetheless, with this pullback, it is interesting to take a look at a few stocks in particular. And I'm going to start off really quickly by looking at Apple. What's interesting about Apple here is, again, it's essentially near the level from where it was last summer, similar to the overall market. But it's interesting to see how it just continues to hold, right around this kind of 174 level where it had bounced previously. So we have kind of this price gap down. This is when the Chinese started to do that crackdown on the iPhones for government workers. And now it is holding along the bottom here. Now we have Keltner channels on this chart. And the fact that it continues to hold the bottom of the Keltner channels might make some people think some support is starting to form. It's interesting to see that it is holding above where it bottomed right back there in August. So, in many ways, whichever way Apple goes, the market will go, given its size and everything else. So it's interesting to see it continue to kind of hold this level. Another name I really want to flag here is Meta. The thing about Meta is that this stock barely pulled back when the overall market, sold off yesterday, and it's actually right in the middle of its Keltner channel. It really hasn't had any kind of significant pullback, and I think this is one that's pretty interesting to kind of keep in mind. The momentum in this one has been stronger than others. This is a heavily traded stock for options traders as well, and their earnings are going to be coming up in late October. So Meta right here really stands out for its relative strength. Another one that's potentially interesting also is Tesla. Tesla is going to have their quarterly deliveries in the beginning of October. They're going to have earnings in mid to late October. They have not yet confirmed those dates, but based on history, that's where they typically stand. And they also remain more or less kind of in the middle of their Keltner channel, the middle of their range here. And what's interesting when you look at Tesla years, we had a level right around 240 that was a support back here in June. Then it broke down, but then we ripped back through it in late August and came back and held and rallied. Now you have this level around 260 or 255, 260 range where it kind of had peaked, broke out, and now it's pulled back and trying to hold that level. So it's interesting to kind of take a look at Tesla here when you consider the fact that it has these potential catalysts coming up. Okay. Now, I think it's also interesting to kind of take a step back and look at some of the other things that are happening when we see where the market is right now. The Federal Reserve yesterday, one of the big things they did was they changed their outlook for next year. That in many ways was the most important thing. They went from saying that next year rates were going to be around 4.25 to say they're going to be over 5%. So they essentially added 75 basis points of overall interest rates, or they removed 75 basis points of easing. And this is very much a sort of hawkish thing that surprised people. But I think it's important to realize that in many ways, the Fed is not only responding to inflation, the Fed is responding to incredibly strong economic data. If we look at our initial jobless claims, which was another body blow to sentiment yesterday, which I think is important to realize, this number yesterday on Thursday was the lowest reading of initial jobless claims, people on unemployment since back at the early time in the year, back in January. It went down to 201,000. So the fact is, this is a leading indicator of economic of jobs. It's one of the most quickly reported numbers, and it's continuing to show a very strong economy. We've had other numbers recently, things like retail sales and stuff, that they continue to point toward a strong economic cycle. And in many ways, that just simply gives the Fed less incentive to be doing anything in terms of easing anytime soon. So in some ways here, we have a situation where the inflationary picture actually has shown some improvement, especially if we continue to look at the way that that rents, which are such a strong part of the inflationary index, that they have continued to fall. And there's been a lot of evidence that rents are going to continue to fall because of new inventory of apartments coming online across the United States. So at this point in time, in many ways, we have to separate. In some ways, the market, at least, is looking to separate between what the Fed is doing because of inflation versus what the Fed is doing simply because they can, because of the strong economy. And the thing, though, at the end of the day is that if inflation continues to ease lower, then the Fed is more likely to lean in that direction in terms of interest rates than in terms of simply worrying about the job market. At least that's the way the market wants to kind of view it. It's interesting also to look here. This is the Fed Watch tool, the CME Fed Watch tool, which shows the projections of interest rates. In this case, I have it set to December. And if you look here, we've basically seen a 57% percentage, right around 57% that we're going to remain at our current level through the end of the year. And what's interesting is, even with the hawkish Fed statement this week, we saw no change. So the market is not believing there's going to be another hike this year. The market is essentially looking here and they're saying that we think the Fed is being too hawkish. And it's important also to realize that in many ways, the Fed is at a spot where they got caught behind the curve 18 months ago. They said inflation was going to be transitory. They had to scramble to catch up. And the market seems to be realizing this political reality here, that the Fed is going to be overly hawkish, or at least overly aggressive in their tone, because they don't want to get caught again on the wrong side of things. But at the same time, the market believes that if inflation continues to ease, that the Fed will not necessarily follow through on what it's saying at this point in time. The other thing I want to also point out is that that this is the relationship between the 10-year Treasury and the 2-year Treasury yield. And it has really kind of come up, which has shown how longer term interest rates have risen. And the question here is, can they normalize and move back up to where they were? This remains a risk in many ways because the 10-year Treasury yield is a really important NX.X on the TradeStation platform. It's a very important measure of interest rates in the overall economy. And at this point in time, it had that move yesterday after the Fed, and it's easing back down today. So this remains the single most important chart in my view right now. This is at a level where it's the highest it's been since like 2007, and it's if it continues to go higher, that will be a risk to the market overall. However, it's at a level where people can say that it is at a long-term high, and if inflation is going to come down, people who are looking at as long-term, bond investors, could start to be seeing value in this. So it's important, I think, that we just continue to watch the 10-year Treasury, not for trading it, but essentially understanding where the market sees things going. If we continue to see upside in the 10-year Treasury, that could create more fear in the equity market overall. All right, let me see if there's some other things I did want to mention. I want to take a quick look at what's happening with the euro, because the euro is in many ways similar to, it's going to go in the opposite direction of interest rates. And the euro is not going to new lows. The dollar is not breaking out to new highs. When you consider how hawkish the Federal Reserve was yesterday, on Wednesday, and we're not seeing that move higher in the euro, that is also showing you that the market here doesn't truly believe that it's going to happen. And this is something also where if we start to see a recovery in something like the euro, that is going to correspond to more confidence in the equity market overall and lower yields. That's the way it historically works. And if you think about it, if the euro weakens, that raises the value of profits that companies earn overseas. It's a net positive for profits, and it's usually a net positive for equities here. So it's also important to remember that there was a real sell-off in the euro a year and a half ago when the Fed started hiking, and we're not seeing that same sort of aggressive movement as we did see before. It's also something I want to point out here that if we kind of look on the week, now I have my radar screen set up here to see who's kind of performing well. And what we kind of see this week is we see some surprising strength in things like gold and silver, which have also not reacted all that bearishly to the news. And these also tend to follow, or they actually lead very often, what the euro is going to do. So to see this overall kind of stability in things like precious metals, stability in the euro, says at this point in time, the market doesn't want to fully believe that we are going to see that kind of worst case hawkish scenario. The thing to be looking at will be to take a look and see what happens, like I mentioned, when we get out to October 6th and we get the non-farm payrolls. The last thing that I want to do is quickly mention that one of the things that has stood out to me this week has been some strength in the healthcare stocks. And I think that's kind of interesting because they are often a kind of defensive area. They performed well in late 2022 when the Fed was hawkish and the market was struggling. And I want to point out United Healthcare, because United Healthcare had a very strong bullish move coming off this sort of the Fed policy here. And so, for me, it's interesting to look at this as a major healthcare name, major health insurer. Another major name that has been a long-term growth stock in the healthcare space, mostly medical devices, is Danaher. This company also has been kind of trying to push higher. They have a spinoff coming soon. And it's interesting just to see some of these healthcare names stabilizing at a time when, when the overall market is falling. I just think it's interesting to take a look at it, especially something like United Health, to see it coming off these lows. They had a strong earnings report right here, and they had some long-term lows here that they've managed to remain above. So this is a stock that has been, pretty bearish for most of the year. But if you look at it over the long term, it's just essentially has kind of moved sideways. And it's interesting, I think, just to kind of see the relative strength in a negative week. Another one that has been one of the strongest performers in the S&P this year has been Eli Lilly. This pullback in the market has brought them back to the bottom of their Keltner channel. And for people looking, just for trend following, this has been an interesting name that has had a lot of good news for their. First, it was the Alzheimer's drug, then it was the weight loss drugs that they're working on. So these are just some names that stuck out to me at a time when the market overall, faces this pullback. So I want to just quickly end by just going back and look at the S&P and just kind of reminding folks that this is a pretty important level here. And it's not to say we're going to hold it, but the fact is that right now people are looking and they're saying that this is an area where we've seen support before. And a lot of now the sort of the news has hit. And now the question is really, can we hold this level, or do we start to see more of a push higher in those bond yields? Those are the kind of key things to watch here I wanted to highlight. Let's also not forget about the fact that Apple continues to try to hold an important level. And this might also be another sort of indicator for the broader market. So I want to thank whoever is watching for watching. We are going to be doing these on Thursdays. We're going to start live streaming them in addition to doing them on the TradeStation webinars. But for now, I want to just thank everyone. Hope everyone has a great weekend. And please feel free to tune in to Market Trends next Thursday. We're going to be doing it at 2 p.m. on Thursday. You can go to tradestation.com for more. Thank you so much, folks, and have a great weekend.